If you have ever wondered why your capital melts away while others build empires on the wreckage of your hopes, cast aside the comforting lie of luck. Most people prefer to believe in blind chance because it absolves them of responsibility for their own poverty. But if you begin to study the history of markets with the cold attention of a predator, you will see that the most catastrophic crashes never happen by accident. They obey patterns that are as predictable as the ocean tides. In March 1980, the price of silver collapsed from $50 to $10 per ounce in just a few days. The crowd called it a tragedy, a curse, an evil fate. But it was neither bad nor good luck. It was an economic machine working exactly as it was designed to work. When you understand the true incentives, you begin to understand behavior. And when you understand behavior, you realize that what seems like a coincidence is, in reality, the logical and inevitable consequence of decisions made long before the first explosion occurred. You must learn this lesson if you want to protect your wealth in a world where the same scenarios repeat endlessly, with only the scenery and the names of the assets changing. History is the most expensive and effective teacher, especially when it comes to speculative bubbles. What happened with silver was not the first, and certainly will not be the last, example of how greed and leverage create and destroy fortunes in a matter of weeks. To realize why silver crashed at the precise moment the margin call rang out, we must go back to late 1973, a time when this machine of destruction was just beginning to be assembled. The world was suffocating from high inflation. The dollar was weakening before everyone's eyes, losing its purchasing power with every breath the system took. In such times, gold and silver cease to be just metals. They turn into a safe haven, the last bastion against currency devaluation. It was in this context that two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, decided to make the main bet of their lives. They didn't just want to invest in silver like a cautious layman dreaming of a pension boost. Their ambitions were more cynical and grand. They wanted to corner the global silver market. If you look closely, you will realize this was not an impulsive decision. It was a calculated strategy built on the foundation of a simple economic theory. If you control the supply of what everyone needs, you dictate the price to the whole world. The Hunt brothers began buying physical silver. Tons and tons of metal began to flow into their vaults. But for their grandiose plans, this was not enough. They needed leverage. They needed futures contracts. They craved more silver than their billions could buy outright. It was at this moment that the collapse machine began its motion. When you use leverage to bet on any asset, you don't just open a position. You create a time bomb that will detonate the very second the market decides to move against you. History teaches us that every speculative bubble follows the exact same script. First, a legitimate reason for price growth appears. Then, smart speculators enter early and skim the cream. In the third stage, greed paralyzes the crowd's brain, attracting more and more people using increasing amounts of leverage to maximize their profits. In the fourth stage, the price soars so high that it completely loses touch with any economic reality. And in the fifth stage, something breaks. And when the system cracks, the destruction is lightning fast and brutally cruel. Silver in 1980 executed this scenario flawlessly. You need to understand three fundamental principles that rule all markets if you don't want to end up like those ground to dust by the millstones of history. The first principle states, Leverage amplifies both profits and losses. When the Hunts bought futures, they weren't just using their own money. They were using borrowed funds, essentially backed by the very silver they were buying. This meant that for every dollar invested, they controlled a much larger volume of metal. If silver rose by 10%, their profit was 50%, 100%, or even more, depending on the size of the leverage. But the market has a universal rule that cannot be bypassed. That which multiplies your triumph multiplies your fall with equal force. If the price fell by 10%, they didn't just lose those 10%. They could lose half, all their invested funds, or even an amount exceeding their investment. The second principle, margin requirements, which are the immune system of the market. A margin call is an alarm signal that goes off when your losses become so large that you need to immediately deposit additional money to keep your positions open. It is a fire alarm that screams when the flames are already licking the ceiling. Markets created this mechanism not to help you, but to protect the system from people like you. By using leverage, you make a promise. If things go bad, you have enough liquidity to cover the losses. A margin call is the moment the market comes to collect on that promise. The third principle, forced liquidation, spawning vicious cycles. When you receive a margin call and don't have the cash for a deposit, you are forced to sell. The market doesn't care if you believe the price will rise tomorrow. It doesn't care that you are selling at the worst possible moment. You must sell, and you must do it immediately. And when many people are forced to sell simultaneously, the price falls into the abyss. The price drop triggers new margin calls for other players. New calls lead to new forced sales. It is a vortex that sucks away fortunes in days. It is this triad of principles that explains what happened in March 1980. The Hunt brothers used colossal leverage to hold gigantic positions. When the price began to slide down, they got the first calls. Unable to deposit enough funds, they were forced to begin liquidation. Their sales crashed the price even harder, provoking an avalanche of margin calls for everyone else. It was not an accident. It was the triumph of mechanics. You are used to thinking of debt as something mundane, a mortgage, a car loan, or burdensome credit card interest. But in the world of big capital, debt is not a burden. It is high-octane fuel that can either launch you into orbit or burn you alive on the launch pad. Leverage is a tool that turns an ordinary investor into a demiurge or a dead man walking. When the Hunt brothers started their game, they weren't just buying silver. They were creating a financial lever of such force that it could overturn the globe if the fulcrum proved strong enough. They used futures contracts, promises to buy metal in the future at a price fixed today. And this was not just a transaction. It was a biological mutation of their own risk. The mechanics of leverage are simple and ruthless in their mathematical purity. When you use leverage, you operate not with your money, but with borrowed funds, backed by the asset you are buying. This means that for every dollar you invest, you control the value of silver worth a much larger amount. If you invest $1 million with 10 times leverage, you hold an asset worth $10 million in your hands. This gives you the illusion of divine power. If silver appreciates by just 10%, your profit is not 10%, but 50%, 100%, or even more of your initial investment. Your brain at this moment is literally swimming in dopamine. Every number on the screen confirms your genius. Every cent of growth feels like a physical expansion of your power. You begin to believe that you are smarter than the system because you made other people's money work for your greatness. But the lever is always a double-edged sword. The universal rule of the market, which most ignore in the ecstasy of growth, states, "That which multiplies your profit multiplies your losses with the exact same precision and fury." If the price of silver drops by that same 10%, you don't just lose a tenth of your capital, you lose half, a full 100%, or even more than you ever had. At this moment, your body chemistry changes. A dopamine paradise is instantly replaced by a cortisol hell. Every downward movement of price is a blow to your survival. You are no longer the owner of the asset. You are a hostage to a mathematical function trending towards zero. Many Americans today repeat the Hunt brothers' mistake without even suspecting it. You use leverage when you take financing to buy a house. You use leverage when you keep money in stocks while having outstanding credit card debt. You use leverage when you take a loan against your own home to invest in other promising assets. The difference is only in scale. The Hunts took this concept to absolute absurdity. They bought so much that their own actions distorted the market, pushing prices up and creating a false sense of security. They felt like masters of the situation, owning billions on paper. But the truth was that they were building a time bomb set to explode the second the market simply paused. The problem with gigantic leverage is that it deprives you of maneuverability. When you control huge positions on borrowed money, you become too heavy for the world you inhabit. The Hunts became such large players that their very presence in the system was an anomaly. They resembled an elephant trying to get out of a kiddie pool. Any movement creates giant waves that threaten to drown the elephant itself. While the price was rising, it seemed like a triumph of will. But behind the scenes, the mechanism of forced liquidation was already ripening. The irony of fate is that if they had bought the same amount of silver over many years without using leverage, they could have kept their fortune forever. But greed forced them to demand everything at once, turning them into the perfect target for the system. You can own all the silver in the world on paper, but physically, you become a prisoner of your own weight, unable to leave a room where the door has suddenly become too narrow for your ambitions. You must understand that price is the greatest lie humanity has ever invented for self-deception. In normal times, it seems like a reliable indicator, but in moments of speculative psychosis, price turns into a hallucination, a collective delusion that has nothing to do with the physical world. My brother and I watched this from the inside, seeing how the reality of silver, cold, heavy metal, gradually dissolved into a fever of numbers. Every bubble in history, from tulips to railroads, follows the same script, which we executed to the last comma. First, there is always a legitimate reason: high inflation, a weak dollar, the search for a safe haven in a world where paper money turns to dust. Gold and silver seemed like the only things that could not betray you. In the second stage, those called smart money arrive, speculators with cold reason who enter early, when the risks are still justified. But then begins the third stage, the most dangerous and sweetest stage of greed. It acts like a drug, shutting down the frontal lobes of the brain and leaving only the primal instinct to seize. People see the price crawling up, and a dangerous illusion is born in their heads, the belief that this growth will last forever. When silver cost $5, no one needed it except jewelers and industrialists. But when it reached $40, $45, and finally $50, a line of crowds crazed with greed formed for it. This is the fourth stage, a complete detachment from economic reality. At this moment, you are no longer buying an asset. You are buying a chart aiming for infinity. We created this vortex with our own hands, buying contracts with such aggression that our very presence distorted the market structure. We made billions on paper, and it was more intoxicating than the most expensive cognac. But hidden behind this triumph was a deadly trap. The higher the price soars, the more fragile the construction becomes. You begin to believe that this time is different, that the laws of gravity no longer apply to your fortune. But the fifth stage is inevitable. Something always breaks. The bitterest realization comes when you understand that you have become too big for your own success. We bought so much silver that we became the only significant player on the field. And therein lay the irony of our fall. We owned the market, but that is precisely what deprived us of the ability to exit it. Imagine an elephant that, in a fit of joy, jumped into a tiny kiddie pool. Every slightest movement, any attempt to shift or get out, creates giant waves that splash water out of the pool and threaten to drown the beast itself. We were trapped in an asset we ourselves had inflated to the heavens. We became so massive that any step toward selling would have turned into a suicidal collapse. We stood at the peak of the $50 summit, realizing there was no more air up there, and the descent would not be a walk, but a fall into the abyss. The system always senses imbalance and strives to correct it, using the most brutal tools in its arsenal. You are used to considering a margin call an annoying technical error or a temporary difficulty that can be waited out if you have nerves of steel. But this is another lie with which amateurs lull their fear of the abyss. In reality, a margin requirement is the immune system of capitalism itself. When you use leverage, you inject the infection of excessive risk into the market's veins, and the system, possessing a self-preservation instinct, inevitably produces antibodies to destroy the pathogen. A margin call is not just a broker's phone call. It is the moment the market collects on the promise, when it presents you the bill for your hubris. Markets created this mechanism for one single purpose: to prevent a situation where one crazed speculator could bring down the entire building of the world economy. In March 1980, we felt this immune system sink its teeth into our throats. When you operate billions on borrowed funds, you are essentially making a solemn vow. If the situation goes according to the worst-case scenario, you will find enough liquidity to cover every penny of the loss. A margin call is the second when the market stops believing your words and demands physical proof of your solvency. If you cannot deposit additional funds to hold positions, the system simply strikes you from the list of the living. Your convictions, your forecasts, your faith that tomorrow the price will go up again, none of this matters. At this moment, a real neurochemical drama begins to play out in your body. Cortisol floods the cerebral cortex, paralyzing the ability to plan for the long term and leaving only one, most primitive reaction: flight or paralysis. You look at the screen where the numbers of your fortune melt faster than ice in the desert, and you realize you are no longer the subject of history, but merely fuel for its mechanisms. Forced liquidation is absolute violence against the investor's will. You are forced to sell, and you are forced to do it immediately, at the worst possible moment. When the price is already in free fall, the mechanics of the vicious cycle come into force. The most efficient meat grinder ever created by man. When you, possessing a gigantic position, dump your assets onto the market at any price, you yourself push the quotes even deeper into the abyss. Your fall triggers new margin calls for those who stood beside you. They, too, begin to sell, creating an avalanche that cannot be stopped by any incantations. It is a vortex that destroys fortunes accumulated over decades in just a few trading sessions. In March 1980, my brother and I found ourselves at the epicenter of this tornado. Our positions were so large that every action we took to save capital only accelerated our total ruin. We made the classic mistake that millions repeat. We decided we could negotiate with the system we ourselves tried to subdue. But the economic machine has no ears to listen to your excuses and no heart to sympathize with your losses. It functions like a living organism, shedding excess weight to survive. Our giant positions in silver became that very excess, which the market decided to sever without any anesthesia. We didn't just lose money. We watched the consequences of decisions made in moments of our greatest triumph materialize. The crash was not an accident. It was the inevitable finale of a play we wrote ourselves when we decided to bet everything on one card and forgot to leave ourselves a path for retreat. This March collapse was merely the moment of truth when our mistakes took flesh in the form of empty bank accounts. It was the triumph of mathematics over ambition, a lesson everyone learns sooner or later if they forget humility before the power of market cycles. The machine worked perfectly, burning out greed and restoring balance, just as it had done for hundreds of years before us and will do for hundreds of years after. Many make the fatal mistake of measuring their worth by the number of zeros in the assets column. But in a moment of market agony, these numbers turn to dust if you cannot convert them into cash here and now. Liquidity is not just a financial term. It is the only oxygen that separates a survivor from a corpse when the system begins to collapse. My brother and I made a classic blunder that millions repeat today. We invested all available money because we believed that idle money is lost money. But the truth is that idle money is the only resource available to you in those seconds when it is needed most. In March 1980, we possessed a colossal fortune in silver, but were absolutely destitute when it came to meeting margin call obligations. You must realize that your diversification is, most likely, a dangerous illusion. Most people believe they are protected because they own shares in 10 different companies. But if all those companies collapse simultaneously, your protection will turn out to be a leaky umbrella in the epicenter of a hurricane. True diversification is the art of owning assets that behave diametrically oppositely, depending on the market climate. You must possess that which grows during inflation, and that which wins from deflation, that which blooms in periods of economic growth, and that which serves as armor during a deep recession. It is a complex cocktail of stocks, bonds, commodities, real estate, and foreign currencies, where the goal is not to hit the jackpot in a specific situation, but never to lose everything at once under any scenario. We lost our empire because we violated a fundamental law of survival. Always keep a significant portion of your capital in assets that can be turned into cash without losing their intrinsic value within a single day. These could be savings accounts, certificates of deposit, or short-term government bonds. The general rule, which you must memorize like a prayer, states, keep a sum equal to your expenses for 6 months in the most liquid form possible. And if you, like us in our time, play risky games with volatile assets, this reserve must be significantly larger. In that fateful March, we found ourselves locked in a room where the walls were made of pure silver, but we didn't even have a handful of copper coins to open the door. Many Americans today walk the same path, investing every last cent in tech stocks or real estate, convinced these markets will never fall. They look at their accounts and feel rich, forgetting that wealth is a function not only of volume, but of accessibility. Without a safety cushion, you operate without a safety net. And when panic seizes the markets, and they always panic sooner or later, you will find yourself forced to sell your best assets at the most pathetic prices just to survive one more day. The difference between speculation and true investing lies in the ability to stay in the game for an unlimited stretch of time. My brother and I lost not when the price of silver went down, but when we created a system devoid of flexibility and oxygen. The true greatness of capital is revealed not in the moment of its triumphant rise, but in its ability to survive a period of total reset, preserving the core for the next cycle. Your fortune must be a monolith, capable of withstanding any pressure, not a house of cards that scatters from the first draft out of a broker's office. Ultimately, this is the line separating those who were rich for a moment from those who remain rich for a lifetime. History never repeats itself with pharmaceutical precision, but it invariably rhymes, creating a rhythm heard only by those who know how to clear their consciousness of the crowd's noise. All existing assets, without exception, pass through cycles of extreme highs and crushing lows. If you understand this fundamental truth, you acquire immunity to panic in moments of crashes and maintain icy calm when everyone around loses their minds from the euphoria of growth. The problem of the majority, and the fatal mistake my brother and I made in 1980, lay in the absolute conviction that the current trend would last forever. We had no plan for if silver began to fall. We believed in our strategy so blindly that we didn't even consider the possibility of our own wrongness. A true architect of capital always has a protocol of actions at their disposal for the event that their investments lose 20%, 50%, or even 80% of their nominal value. This does not mean you should live in anticipation of a crash, but you must be prepared for it technically and mentally. Having a rigid plan allows for rational decisions in those seconds when animal fear paralyzes everyone else, forcing them to make the most primitive and destructive mistakes. The anatomy of counter-cyclicality. To not just survive, but dominate the market's food chain, you must master the art of going against the current. My brother and I lost precisely because, in the end, we became part of the crowd. When everyone was buying silver, we bought even more. When everyone was increasing leverage, we took it to absurdity. An elite investor always acts as a mirror to the masses. He exercises extreme caution in moments when public confidence reaches its peak. He becomes aggressively optimistic when the streets are awash with blood and the market is gripped by hopeless pessimism. He locks in profits while the crowd demands the banquet continue and buys up assets when everyone else is getting rid of them in terror. Psychologically, this is one of the hardest tasks, but it is the only effective method for protecting and multiplying wealth over the long haul. The market is a machine for redistributing funds from the impatient and greedy to the disciplined and calculating. The system's verdict. The crash of silver in March 1980 was not a whim of fate. It was the inevitable consequence of decisions we made in moments of blinding growth, when everything seemed controlled and predictable. We lost our fortune not on the day of the margin call, but the very moment we decided to bet everything on one card and renounced the right to make a mistake. The economic machine is extremely efficient at correcting imbalances. The stronger the distortion of reality, the more brutal and bloody the subsequent correction will be. We created a giant disturbance in the silver market, and the market destroyed us to restore its integrity. True wealth has nothing to do with a one-time win at the casino or brief possession of inflated billions. It is defined by the ability to continue the game decade after decade, maintaining a cool head and unwavering discipline. This is where the fundamental gulf between speculation and investing lies. To be rich for one moment is the lot of those who bet it all. To be rich for a lifetime is the privilege of those who respect the power of market cycles, diversify risks, and never allow their greed to blind the instinct of self-preservation. History is a magnificent teacher, but it reveals its secrets only to those willing to learn on others' bones, not their own. Now you know the mechanics of inevitability. Your task is to ensure that the next time the market decides to purge the system of weak players, you end up on the side of those who coldly observe the process, having eternity and infinite liquidity in reserve.